Welcome back traders to another exciting episode of our channel. In today's video, we're diving deep into the captivating world of Candlestick Mastery. Get ready to unlock the secrets of predicting market reversals with precision. Whether you're a seasoned trader or just starting your journey, understanding candlestick patterns is essential for spotting potential trend shifts and making informed trading decisions. In this comprehensive guide, we'll take you step by step through the most powerful candlestick patterns and teach you how to harness their predictive potential. Steve Nison, your guide on this enlightening journey, with years of experience in the financial markets, have honed his skills in analyzing candlestick patterns to identify high-probability opportunities. In this video, he is sharing his insights and techniques to help you achieve mastery in this crucial aspect of trading. From classic patterns like doji, hammer, and engulfing to more complex formations, such as evening star and hanging man, we'll demystify each one and equip you with the tools to anticipate market reversals like never before. But that's not all. We'll also explore advanced strategies, combining multiple candlestick patterns to validate our predictions and optimize our trading decisions. Get ready to witness the precision and accuracy of candlestick mastery. Our goal is to empower you with the knowledge and skills to confidently navigate the ever-changing financial landscape and stay ahead of the competition. So, whether you're a swing trader, day trader, or long-term investor, this video is packed with invaluable insights that will elevate your trading game to new heights. Stay tuned as we delve into the fascinating world of candlestick patterns and discover how to predict market reversals with precision. Are you ready? Let's dive in and unlock the secrets of candlestick mastery together. Forex Central, where traders become masters.
Okay, the Japanese will say, they have a wonderful expression, the power of the market is reflected in a single candlestick line or in a combination of candlestick lines. And we saw before how we could see, read the power of the market or the lack of power of the market by the single candlestick lines, right? The hammer with the long lower shadow, the doji, the market has reached a point of indecision, the shooting star, the market's rejecting higher levels. But we could also read the power of the market based on candlestick patterns. So a bullish engulfing pattern, the market is moving down, and then we have a white candle engulfing, hence the name, a black real body. What is this showing us about the psychology of the market? Right, the bears are in control. Ideally, we want to see the first real body small because we want to see the bearish momentum losing steam. And then a white candle wraps around the black real body. Okay, normally, in equities, I like to see volume confirming it. Okay, high volume on the white candle, light volume on the black candle. We don't have that advantage in the Forex market. So white candle wrapping around a black candle. Now this is a non-Forex bullish engulfing pattern. White wrapping around the black. You could use this in a Forex. The only difference is, again, because of the 24-hour nature of the market, this is non-Forex, this is Forex. So the difference is, in non-Forex, normally I want to see the open below the black real body's close. Forex, not as strict because the opening and close are going to be the same. Even if the opening and close, that's fine. As long as that white real body is higher than the black real body, this is perfectly acceptable in Forex markets. Yes? Yes, and the intraday, and we're going to talk about that intraday. This is true with intraday also. Exactly, because in any other market. Right. The question is this going to be true with any intraday in any other market? And the answer is yes, because the opening on a 15-minute chart is almost going to be always the same as the close of the prior 15-minute period. Yeah, pretty much in any market. Yeah, and we're going to briefly mention that during the intraday section, but that's true. So here in that prior slide, you see how the opening and closing. I just made a copy of it. The opening and closing are the same. That's a perfectly acceptable bullish engulfing pattern. And if we needed more reinforcement, we had another one over here. By the way, even if it's a pip difference, I'm looking at this now, pip or two. Like this opening may have been a pip or two higher than the actual closing. That's fine. That's okay. Okay, what beside the bullish engulfing pattern here with the white wrapping around the black, what also formed? What was the hammer? The first part, right, exactly. Remember, the hammer could have a black or white real body. So the low of the bullish engulfing pattern, which happens also to be the low of the hammer, should be a support level. Question? Okay, the question is, would I enter the market here on the hammer?
Or after the bullish engulfing has closed?
Okay, so the question is, would I enter the market here or after the bullish engulfing pattern? And I would do both. Either one is fine. The reason for that, look at this risk-reward. Fabulous risk-reward. Gosh. I don't see any, I'd have to even go back further. I don't know if there was a rally here. I don't know if this is a pivot high. I mean, the market could have been going down. But let's say even if this was a target area, I would definitely maybe, because there's no obvious resistance here, maybe look at some Fibonacci retracements, take some profits, 50%, something like that. But even with this hammer, wonderful risk-reward. Yeah, I would still view it as a bull. One of the things that I had to do with the software is define what's a trend, and it's proprietary. But this would be a downtrend to me. Okay. Yeah, that's one of the things I had to think about. How do we know what's an uptrend or downtrend or lateral? So we've come up with a couple of moving averages. We actually use like a moving average crossover, but this would have been in a downtrend. Yeah. Okay, this obviously is in a downtrend. And here's a bullish engulfing pattern. And even, again, although this is classic. What we normally want to see is a much taller white candle and a small real body. Because you want to see the bulls really gaining a foothold on the market. And if for some reason you didn't have a chance to buy in the bullish engulfing pattern, maybe you weren't watching the market, there's the pound. As long as it holds support based on the close. One technique you could do, and I do this with windows. One technique you could do, let's say you're flat. You're flat during the session. For some reason you weren't, you didn't look at the bullish engulfing pattern or you didn't buy on it. And you see the market breaks the support intra-session on that bullish engulfing pattern. As soon as it gets back above that broken support area, you can buy. Now what you could do is set an intraday stop. Because you're saying, okay, if the market is strong, I don't think it should get under here intraday again. And you can keep a stop intraday under those lows. But here's another bullish engulfing pattern. Getting back to the question, how do you trade with it? Once again, this looks like a fine risk-reward. Notice how I always say, one of the things I always talk about, risk-reward. If you don't have a good risk-reward, just don't do the trade. We're going to have a whole section on that. You buy in the bullish engulfing pattern. The low of the bullish engulfing pattern based on the close is your stop-out level. And my target is up there. I just use pivot highs. Just to refresh your memory, a pivot high is a high that is higher than the two highs before and after it. And a pivot low is a low the low is lower than the two lows before and after it. So essentially it's the most recent high. Let me show you this red line here that just came up with the arrow here. Is this a bullish engulfing pattern? Okay. Did it work? No. As soon as the market closes under it, if you're long, you're wrong. This trade, actually, I was going to say maybe it didn't work out, but maybe it would have. I don't know what happened here, but this looks like a resistance area. So just based on this, I don't know. But based on this, if you're buying it here, my upside target might have been over here. So actually, before the market broke the support on the bullish engulfing pattern, that may have actually worked out. But I'd have to look back further to make sure this is a resistance area. But let's assume it's not. As soon as the market closed under the bullish engulfing pattern, if you're long, you should be out. Or if you're looking to sell, that's the time to sell short. Obviously, when you get the bullish engulfing pattern, the second one, if you're short, you should be out of your short positions. Okay, as the market conditions change, we need to adapt to the changing market environment. Bearish engulfing pattern. Pretty much everything I said with the bullish engulfing pattern, on the flip side, the bearish engulfing pattern, the market is moving up, and then we have a black real body wrapping around, engulfing a white real body. Bears are wresting control of the market from the bulls. Non-4X. Yes?
Please go back to your slide 43. Let's say you go long. Similar question. Let's say you go long at your bullish engulfing pattern.
If we go long at which bullish engulfing pattern? The first one or the second one?
The second one.
All right, so we're going long at the bullish engulfing pattern.
The target price is up over there, the previous high.
Mm-hmm.
And then you see that doji and that black candle.
Right.
Would you consider closing?
Yes, consider. We're going to look at adapting to the market, shifting our stops as we get new market information, because as time progresses, the way the market looks here is different than the way the market looks here.
Yeah.
And we need to adapt to it. So with something like this, I would definitely move up stops, take some profits. Because this is not confirming a resistance area, I still probably want to stay net long, but definitely I'll be taking some profits here. And I bet you this is probably right around I bet you this is around a 50% retracement over here. Okay, non-4X, 4X, opening, closing are the same. Okay, here we have a bearish engulfing pattern. And why do you think I put a rectangle around those three candle lines? What happened with that black real body? How many white real bodies? Or it could have been a doji. Did that wrap around? Two. All right. Doesn't mean the market's going to fall out of bed here. The euro is going to fall out of bed here. It's just dramatically increased the likelihood of a turn. One of the trading principles we'll be looking at later, one of my Nison trading principles, is candles don't give price targets. People don't realize that. Candles do not give price targets. You're going to have a separate slide on this. But the reason I wanted to mention that is when I talk about something like the black real body engulfing two white real bodies, don't think in the back of your mind that this is going to happen. Think in the back of your mind that the probability of the market turning has increased, more so than it would have been a black real body wrapping around one white real body. And it should be a strong resistance area also. Okay, here we have a bearish engulfing pattern, a little bit of an uptrend. Okay, now I'm going to put a circle here with the question mark. Now, that's a black candle wrapping around the white candle. Remembering one of the Nison trading principles that we talked about before about trend, is that a bearish engulfing pattern? Okay, the shape is right, but think about the preceding trend. A bearish engulfing pattern should come after what? An uptrend, even a short-term uptrend. So this is not a bearish engulfing pattern. Let those who misuse the candles go short on that. So whenever you're defining a candlestick signal, look at the shape and the trend. Yes?
No question, why is that not a trend? From the steady top to the next.
Over here? Well, I'm just viewing over here. This is too short. I'll look at 3 or 4 or 5 candles, not 1 or 2. So to me, the immediately preceding trend is this, which is down. Okay, here, important highs for those who are following the euros. A bearish engulfing pattern, which became resistance with another bearish engulfing pattern. Does this mean the euro is going to collapse like that, or the probability the market's going to turn much higher? It was the latter. Yes? Yeah, the pattern is something called the last engulfing, and I talk about that in my advanced DVD, but I'll mention it very briefly now. Essentially, elastic engulfing would be the market's moving up, and it's not so much a candlestick signal to use, but just warning you about using it incorrectly. The market's moving up, and now and then you have this. Okay. Now it's white wrapping around the black. What is that? If the trend is right, a bullish engulfing pattern. What's wrong with this? The trend is not correct. The Japanese call this a last engulfing pattern because it's supposed to be bearish. I don't view it that way. I just view it as it's not really that bullish. What the Japanese will say is that the reason they call it a last engulfing pattern is because you fall in love with the market and you both perish together. They call it double lover suicide. And the point is that it could be like a buying climax. So if you have very high volume in non-forex and you get something like this, and then you have confirmation by a lower close the next day, the Japanese view that as bearish. I don't talk much about that except in my advanced material. The main thing is that just know that's not a bullish engulfing pattern. But that's what the Japanese call last engulfing pattern. And the flip side is this. This is what they would also call this a last engulfing pattern because the trend is wrong. It's a bearish engulfing pattern. But the bearish engulfing pattern has to come after an uptrend. Okay, here we have a couple of engulfing patterns. And the reason I like this slide is, and I don't have to convince you of the many advantages that the candlesticks have over the bar charts, but this is just a very interesting aspect of it that a lot of people don't think about. The engulfing pattern, all we need is real body wrap around real body. That's actually a question I'm asked a lot. Does real body have to wrap around the shadows? And the answer is no. An engulfing pattern, real body, wrap around real body. So we all agree, I hope, a little bit of a downtrend that on your left, a white wrapping around the black. And this is interesting. You could see how, this is why I give it a pip or two. You see how this opening here is actually maybe a pip or two below the prior close instead of exactly at it. So don't worry if it's a pip or two difference. Anyway, this is a bullish engulfing pattern. And during a move up, it's a bearish engulfing pattern here. Now, let me show you. In the West, we have something called an outside or a key reversal session. Okay. And what a key reversal, this is a bar chart here, bar chart lines I made here. The market makes a higher high. This is a negative outside or key reversal. The market makes a higher high and then closes under the prior close. Okay, it's an outside reversal with a bar chart. What that means, obviously, is that this has to have a higher high. Now, with this engulfing pattern, did this black candle make a higher high? No. So if this was a bar chart, would it have been an outside or key outside reversal? No. Wouldn't have been any turning signals. On the bullish engulfing pattern, exactly the same thing. A bullish outside key outside reversal means that this candle would have to make, this bar chart, if it was a bar chart, this bar line would have to make a lower low. Did that make a lower low? No. So it would not have been a reversal signal with the bar chart, but was it a reversal signal with the candlesticks? Yeah, white wrapping around the black. The lower the bullish engulfing pattern should be support. The higher the bearish engulfing pattern should be a resistance area. Okay, one thing to look at, a little bit more advanced. Question?
On the last chart,
Mm-hmm.
would you, looking at this, would you set your resistance at the two prior dojis or at this new high of the last?
Okay, great question. Would we set the resistance at these two prior doji or up here? Okay. Now, did these two prior doji hold as resistance based on a close? Yes. Okay. But once you got here, what you could do is then you'd have to move it up a little bit more because then you'd have to close above here.
So you would raise it?
Yeah, I would have raised it because the bearish engulfing pattern, exactly. What you might want to do is, let's say you're here and you're getting a whole bunch, the doji, the bearish engulfing pattern, but why wouldn't you be selling short here? Okay, the trend I'd probably have to see, I'd probably have to put a moving average on there, but somebody said support. You're right at first support. Short term, but isn't the market at a support area? Remember, we only have this much data now. All right? It's at a support area. Short term, not major, but nonetheless, this is a support area, and I'll show you this. Okay? And then if you're thinking for next day confirmation, is it still holding support? So the setup might be there. A lot of turning signals. But if you're selling on this bearish engulfing pattern, you're selling at a support level. I'd rather have the market break the support, even a couple of pips, or certainly here. I don't care if that's a spinning top or not. It broke the support area. This is still probably an okay risk reward. But we should always think about if the market's at support or resistance at the time we get the signal, because if it is, you don't do the trade. Yes?
Wouldn't you have a higher confidence of going short on the engulfing pattern if you've had another resistance 2 or 3 months prior back to that?
The question is, wouldn't we have more confidence if going back on the chart here, this was confirming a resistance area? And the answer is yes, definitely. But I would still like to see a break of that support area. Here are a couple of engulfing patterns. And one thing we should think about is comparing the size of the real bodies. Ideally, what we want to see is the second real body much bigger than the first real body, to see that the opposing forces are taking control. A bullish engulfing pattern, we want to see the bulls, the opposing forces, the bulls taking control from the bears, bearish engulfing pattern, the opposite. So in the green rectangle, obviously, much larger black real body. That increased the likelihood of a turn. It also increased the likelihood it's going to be resistance. Unfortunately, what does it do for a risk reward? Makes it worse if you're selling it here, but there's nothing wrong for waiting. It may not get there, but anywhere near the prior resistance area to think about selling it. Here we have a couple, this is also a doji, but an engulfing pattern, but these are about the same size, and we're not getting a visual sense. Remember, the candles are very visual. You can flip through lots of charts. In the Forex market, we don't have that challenge. On the equity side, think about how many markets you have to flip through. In the Forex, have a couple of major crosses or pairs. So we don't have that challenge, but if you work during the day and you want to go through the Forex markets at night, you can flip through them very quickly and see the engulfing patterns. One of the things I would note is see if the real bodies are about the same size. If they are, there's not much of a difference between the bulls and the bears. Whether these happen to be intermediate size, you could have a small white real body, let's say a bearish engulfing pattern, a small white real body and a small black real body. Or you could have a really large, let's say a bullish engulfing pattern, a really large black real body and a really large white real body. If they're about the same size, that to me doesn't reflect a market likely to turn. In fact, if you have really big, very large real bodies, the Japanese say it's like an earthquake of magnitude 8. It goes up and down and up and down. So the green rectangle is the one I would be more confident of a market turning. Now, in the non-Forex, we normally want to see the first candle as a spinning top. But because the Forex, you can have a spinning top in one charting package and a doji in the other, this is perfectly acceptable. In other words, a doji wrapping around the real white real body following a doji, or black real body following a doji. Okay. And the reason for that has to do exactly with this. These are both the same days worth of data, different charting packages. One has a doji, one has a spinning top, and they're both, to me, bearish engulfing patterns. So this is a bullish engulfing pattern. Okay, this is another bullish engulfing pattern. And that second candle in the bullish engulfing pattern doesn't look quite like a hammer. Why would that not be a hammer on that second, that white candle? The body's too big, or you could say the shadow's not long enough. The same thing, right? The lower shadow, what we want to see with a hammer is lower shadow at least twice the height of the real body.
On an engulfing pattern,
No.
I'm not engulfing a spinning top.
On a spinning top, no. The question is, on a spinning top, is there any criteria with the shadow? And the answer is no. The spinning top just means it's a small real body. That's all it is. Spinning top and small real body mean exactly the same. Now, if you have a spinning top or small real body or doji with a very long upper and lower shadow, you got a high wave candle. If you have a spinning top or doji with a very long lower shadow coming after a downtrend, you have a hammer. If you have a doji or a spinning top coming after a rally with a very long upper shadow, you have a shooting star. Related to the bearish engulfing pattern is the dark cloud cover. Now, a bearish engulfing pattern wraps around the white candle, and in a non-4x dark cloud cover, what we want to see is the market gapping higher the next session, whether this is an intraday chart or a daily chart. By the way, somebody had mentioned intraday. You can have a gap higher opening. What will usually happen is the big moves in intraday will be between the last candle today and the first candle, the last candle yesterday and the first candle today. You could have something like this. So this could be on an intraday chart. This could be the closing here, and on the next day's opening, the market could gap higher on the opening. Okay, it's rare to have that within the same day on an intraday and a non-4x, but you could have moves like this on an intraday. But non-4x, equities, whatever, we want to see the market opening above, ideally above the prior close, or even better than that, above the prior high. Now, we don't know it's going to be a black real body until the end of the session. What do you think the bulls are feeling here on that opening? Happy or sad? Should I make a little happy face on here again? Sure, they're happy. The market gapped higher in the opening. And by the end of the session, the market closes more than halfway, and this is an important criterion, more than halfway into the white real body. For 4x, that criterion is still there. It has to close below the middle of the at the middle or below the middle of the white real body. 4x, not surprisingly, the opening and closing can be the same. The Japanese will say, with a dark cloud cover, it's a sign of uneasiness at a high price. And the higher the dark cloud cover should be resistance. Okay, so here, and at times I'll look at a weekly chart to get a longer term, if I see longer term support or resistance. Okay, each Friday for our institutional clients, I'll look at a weekly chart. Most of my focus is on a daily or 60 or 30-minute chart. And the reason we look at intraday will be evident later on when we focus on intraday charts, even though most of my clients are swing traders. But here we have a weekly chart, and it's the pound dollar. And classic dark cloud cover became a resistance area with another dark cloud cover. Just because you have two dark cloud covers doesn't mean that the market's going to fall like this. On this red circle here, what would get us nervous about the rally? Not nervous enough to be short, but what would get us nervous? Small bodies, yeah. Yeah, so the trend would be up, but I'd nudge it to neutral. I would not add to long positions there, and this is very valuable information. In the introduction, I had alluded to the fact it's just as important knowing what, maybe I didn't, but it's just important to know what not to do as to do. And knowing not to add to long positions there, very, very important, because we're able to preserve our trading capital. In fact, what I did is on this chart, on the pound here, weekly, I just changed, you'll see I changed the spelling a little bit. Okay, here we have a dark cloud cover, and I'm going to highlight these two areas. The reason these are not dark cloud covers, you tell me. Actually, I think this one is a little obvious here. This one I'll probably have to explain. But why is dark cloud cover, why is at 1 not a dark cloud cover? Doesn't go, great, right. Doesn't go below the middle of the black real body. By the way, what you could do, if you ever have a candlestick line like this where it doesn't go below the middle of the black real body, you could wait for the next session to see if it does then get under the middle of the black real body. And that would be called like a variation of dark cloud cover. That's perfectly acceptable. That didn't happen here. Now, 2, the reason that is not a dark cloud cover has to do with the definition. And the dark cloud cover, the first candle, remember what we want to do with the candles is get a sense of if there's a change in psychology of the market. And obviously with this one, there is a change in psychology. Let me just, with this dark cloud cover, the market opened here. Now, were the bulls very much in charge here on this tall white candle? Yes. Did they really lose control here? There's almost a bearish engulfing pattern, certainly, right? So there's a real shift in psychology between these 2 days. And this is what the candles shine at, giving us reversal signals in 1, 2, or 3 sessions. Okay. Now, let's get, with that in mind, let's look at here. And this is a very common mistake people make also, because it's something I really don't talk about in my books. It's that black real body got more than halfway into the white candle, but is there a real change in psychology? No. Look at that. Look at the size of that white candle. Right? Look at the size of the black candle. No big deal. It's when, classically, bulls are in control, bears take control. So the ideal dark cloud cover, the first candle should be relatively long. It doesn't have to be extraordinarily long, but like the one there. And then we should have a black real body that gets deeply into it. We want to see a real shift in psychology. So the correct answer for 2, the reason it's not a dark cloud cover is because it doesn't meet those criteria. The first real body is not unusually long. Okay, here we have a couple of dark cloud. The arrow on your left points to a hammer, which is support. And a little dark cloud cover. And notice how the market pulled back to the hammer support area, which is interesting. And then we had a dark cloud cover. Now, and this would have been a perfectly fine trade that did not work out. It's going to happen. That's what stops are about. Okay. The hammer was support. Okay. Would we buy on the hammer? I don't know. It looks like a weak close. I probably would want to wait for a little extra confirmation the next day. Although the market's holding the hammer support, I don't like the fact it made a new low close for the move. So in this case, I probably would want to wait for extra confirmation. Obviously got that the next day. Now, if we do the trade or not, can we define what our target is based on the slide? No, we'd have to go back further. So let's assume it is not a good risk reward, so we hold off. And the market does this. What's the first sign of the market turning here? Small real bodies, right, spinning top. I don't think it's a shooting star because the lower shadow might be too long, but at a minimum it's a lower shadow. Okay. Gets a little above resistance, but then a little dark cloud cover here. Now the market pulls back here. Okay. Now one thing we'll look at later is intraday. You may have gotten a bottom reversal signal on a 30 or 60-minute chart. See? If you're using daily charts, you may not have seen that. That's one of the things we'll look at about intraday. I had said before why we could, if you're home during the day, that's the challenge. But if you have access to intraday charts, you may see, for example, on an intraday chart, you may see a hammer down there. So you might buy early. But let's say you bought whatever it is on the close here. It might be an okay risk reward because you're looking to the top end of the trading range. We get here. Probably sell it because of the doji. What's our target? Bottom end of the trading range, right? Okay. Didn't work out. You're out. Okay. So in this case, if you sold in the dark cloud cover, it would have worked out fine. Or if you bought on the hammer, it would have worked out fine. But if you sold on this resistance area set by the bearish engulfing pattern, remember, the doji is also resistance. So we had a couple of reasons for resistance. And the market closed above it. As soon as it does, if you're a momentum player, you're jumping from the long side. If you're short, you're wrong. You're out. Yes?
Is the candle right after the hammer, is that a bearish engulfing?
This one here? Okay. Okay, this is not a bearish engulfing because even if the black candle wrapped around the white candle, remember a bearish engulfing pattern has to come after what trend? Uptrend, right. So that is not an uptrend. Okay, and we'll look at this is actually a bottom reversal signal called a piercing pattern. We'll look at it in a minute. It's the opposite of the dark cloud cover. It's when a white candle pushes into the black real body, not quite wrap around it. Okay. And here we have a dark cloud cover. And I wanted to show you this because the opening and closing are a pip difference. So that's perfectly fine. The opening and closing doesn't have to be the same. In fact, what you may get, just as it opened a pip lower, it could open a pip higher also, or a couple of pips higher. Opposite of the dark cloud cover, just as the shooting star was the bearish counterpart of the hammer, the bearish counterpart of the, the bullish counterpart of the dark cloud cover is the piercing pattern. Market's moving down, non-Forex, for you equity traders or commodity traders. Market opens below the prior low or at a minimum below the prior close over here and then pushes above the middle of the black real body. Forex. Opening and closing are the same. But it still has to have that white body close above the middle of the black real body. Piercing pattern. And think about this also. Remember the dark cloud cover, we wanted a relatively long white candle, then a black candle, get into it to show a real change in psychology. Same thing is true with a piercing pattern. And this is perfectly fine. A relatively long black real body. It's not tremendously long, but it's not a spinning top by any means. And then a white real body to show us. And here, this one's interesting. See how it opened a little below it, the close? Here. See, most of the time it's going to open and closing going to be the same, but this is fine. And you may have a data source where the opening and closing are the same. That's why we can't get hung up. It's not like in equity where you have official prices. There's no official prices in the Forex market. Yeah. One of the I love Forex because it's so great because when I do equity seminars, I'd say about 25%. How many sell short here on the Forex side? I was going to say on the equity side, it's only 10, 20%, and that's after years of the market being down. Forex are like commodities. It's just as easy to sell short as it is to go long, and that's what's great about another great thing about Forex. Okay, this is not a piercing pattern. Why? In that, didn't get 50% more than 50% into the black real body exactly. Okay, here we have a piercing pattern which confirms a support level. And interestingly, look at that support level with those two red semicircles on the left here. Okay, what are those? Two in bullish engulfing patterns, right. Okay, here we have a bullish a piercing pattern. This would not be a good risk reward. Great piercing pattern. It looks like it's really trying to bottom out. But based on those shadows, where's first resistance? We can't see the prices, but I think most of us will agree right here, right? Yeah. So yeah, great piercing pattern. You can't do anything with it this time, but this piercing pattern is is reinforcing a support level. I would certainly monitor that support level if the market gets back there, which it ultimately did. Okay. And I love it when the market breaks support and can't hold it. I love it. We'll look at that. It's called a crack and snap. And it's something I talked about in my other DVDs. How many have my DVD sets here? Okay, quite a few. Okay. I call this a crack. I think in my first DVD it was called a spring, but I love this. So here, market breaks support and can't hold it. What do we have here? That long upper shadow. Is that a shooting star? No, there's really no trend to reverse. Yeah. One of the challenges we have is the market in an uptrend or downtrend. Something else to to define the candlestick signal. Something else that will help us, and we'll look at later, is seeing if the market is overbought or oversold. So obviously, even if you, for some reason, thought of this as a shooting star, which you shouldn't, we should say to ourselves, is the market overbought? And you don't need an oscillator to tell you no. So this shooting star becomes less important. And we'll look at that a little bit later. We're going to look at a lot of stuff later. Huh? Okay. Here we have a dark cloud cover. Now with that dark cloud cover, is the market just visually, does that look overextended at the time the dark cloud cover emerged? Yeah, I would say so. It's overextended. It then becomes more likely when you have a bearish candlestick signal for it to be reversal. Again, in spite of that, I wouldn't short on the dark cloud cover unless we had it confirming something else. Yes?
Is resistance then the tallest wick there?
Yes, on the dark cloud cover, any of the candlestick signals, great question. The question is resistance at the upper wick or the upper shadow. Whenever you have a bearish engulfing pattern or dark cloud cover, the bearish engulfing pattern, the highest high, including the upper shadow, or the dark cloud cover is resistance, the bullish engulfing pattern, the piercing pattern, the lowest low, including the lower shadow, becomes your support level. Great question. The question is, can momentum be substituted for volume? We could use momentum. When we talk about oscillators, we'll look at momentum. The way most traders will use momentum is seeing if the momentum is confirming the move. So I guess in that sense, you could use it as a substitute for volume, because with non-Forex, if the market's moving higher, we want to see higher volume. In Forex, if the market's moving higher, we want to see the oscillator, whatever you're looking at, stochastics, RSI, also moving higher. But unfortunately, I don't think there's really any specific substitute for volume. But that could be viewed as something that can be used as a last case scenario. What's that? Oh, the oscillators? Yeah, oscillators are a lagging indicator. We'll have a section on oscillators, and I don't ever recommend trading solely on an oscillator. It's only if we get a candlestick signal confirming it. To me, the best indicators are the candlestick charts. It's pure price action. Everything else you're doing, you're getting away from the pure price action. The oscillators, the mathematically derived measurements, but there's nothing more important than the pure price action. Okay, here we have what I call a confluence of candles. The market's descending, but as it's moving lower, we have a couple of piercing patterns and then ultimately a bullish engulfing pattern. What's that?
In this scenario, right? So you get excited when you see the first engulfing pattern.
The first piercing pattern. Yeah, this would have been tricky, because he was saying you get excited when you see this, okay, because is it confirming support? Yeah. Now, let me ask you, is it a good risk reward? No, based on this. Remember, your target might be very different than mine, but based on the prior highs, you know, those long upper shadow resistance area, that would not be a good risk reward. But you're right, I would think about scaling back on shorts if I were short. Get excited. The market closes under it. If you're long, you're wrong. Okay, get excited again. And this might be an okay risk reward. I have to take a look at the, my target would still be there. Okay, the low is the low of the piercing pattern. Is it still holding it? So it would still be long in the piercing pattern. It moved under the piercing pattern, but did it close under it? No. Okay, that's not quite a hammer, right? Because the lower shadow is not long enough. But nonetheless, that second piercing pattern is still holding. Okay. Now, this is a question. I don't know if it closed under the low of the piercing pattern, but to me, this would not be a decisive break. Now, for those of you who trade in black and white, say a close under the piercing pattern is a close. If I'm long, I'm out. I can't tell you, a right or wrong answer. But something like this, even if I don't think it closed under the low of the piercing pattern, but assuming it did, if it's a couple of pips, I would give it to the next day, at least the opening. But I'd still be a little nervous. So is the market making lower lows and lower closes? The piercing pattern is still holding, though. Okay. Still lower closes. Okay. Now, this is a very different scenario because we're going from lower lows to higher lows. We have a bullish engulfing pattern. What else besides this? What's with this bullish engulfing pattern? Look at the prior real bodies. Right, wrapped 2 or 3. It wrapped around. Right, it wrapped around 2 or 3 black real bodies. So now I would be very, very comfortable doing a trade here. Very comfortable. Risk reward is good. You have a whole bunch of signals here. Yes?
Would you also give weight to the fact that it closed above the previous candle's high?
The question is, would I also give weight to the fact it closed above the previous candle's high? Not too much. Not too much. To me, it's more important that it wrapped around a lot of real bodies. And you're going from lower lows to the same lows to higher lows. Okay.
If you look at the first piercing pattern,
Mm-hmm.
that is confirming your.
Support area. Okay, the question is, the first piercing pattern is confirming our support area, yes.
Then you have the second piercing pattern, but before you get the second piercing pattern, the black candle is closing below your support area.
Okay, before, okay, here's the first piercing pattern. He's saying it's holding the support at the first piercing pattern. This is still holding support there. It didn't close under it. The next one, right, that's what we're talking about. That's, if you were long in the piercing pattern, you would have been out.
So would you consider going short over there?
Yes. Yeah. Yeah. Well, no, I don't. I shouldn't say yes, no. You don't know where the support is, so you don't know if it's a good risk reward. Okay. But based on this, it looks like a descending triangle. Remember, you could use Western technicals. Okay. A descending triangle means you have horizontal support and lower highs. And when the market breaks the bottom of the descending triangle, you could take the height of the triangle and subtract it. Okay, so that's the way I would be playing it. So let's say we're short and we have a good risk reward. Let's say using the descending triangle as your target, and we're short now. The market broke the support level. In the real world, we're not going to say go from long to short. Okay, unless you have to have good psychology to be able to do that. I love the market. I hate the market. So the market does this, and then once it gets back up here, I would be out of short positions. The question is, would I get uncomfortable seeing this long upper shadow here? I might get a little uncomfortable because it looks like it's confirming. This to me is like a minor resistance area over here. I might get a little bit uncomfortable, maybe scale back a little bit, move up stops. But what I would probably do is look at an intraday chart to see if I saw any real bearish candlestick signals there. So the question is, would I get uncomfortable here and on this long upper shadow? And not too much, but if I saw, for example, a bearish engulfing pattern here on a 60-minute chart, I might get more uncomfortable. Okay, we'll move on to Harami. Okay, a Harami is a small, we're still looking at double candlestick lines. And we looked at spinning tops before, the small real bodies. Remember, spinning top and a small real body mean the same thing. The Harami is a little more specific in its definition. What it means is that it's small real body within an unusually long real body. And the second real body could be black or white. This is a bearish Harami. The Japanese would say there's a change in flow of the market. And a bullish Harami. The market's descending. By the way, these lines, get here. These slash lines to show us the market's moving up. These are not candlesticks. And a bullish Harami is an unusually black real body. Remember the difference in psychology. That's what we're gauging. The long black real body on your right, the bears have command of the market, and then a small real body, black or white, that's within the prior real body. This is non-4x. How do we know this is non-4x? What's the difference? What's happening between one candle, one session and the other? Let's look at the bearish Harami. It's gapping. As soon as you see any pattern with a gap, you know it has to be adjusted for the 4x market. So for non-4x, for 4x, let me show you this also. Once again, bringing out the difference between a bar chart analysis and a candlestick chart analysis. This second black real body within the bearish Harami is also, the way I show it here, is also called an inside session. An inside session is when today's high-low, assuming we're looking at a daily chart, today's high-low range is within yesterday's high-low range. So here, as I display it, is an inside day. But once again, like with the engulfing patterns, all we're concerned about is the real body, or are the real bodies. I'm going to extend the upper shadow on that first spinning top. Okay. That is no longer an inside day, but is it a Harami? Yes. Real body, small real body, yes.
The upper shadow is longer than the higher.
Right.
I mean, you fine.
Right, so the upper shadow that I showed here is now above the prior upper shadow, but that's not important as long as that real body is within the prior real body. Right? And what's nice about, unfortunately, about the non-4X is that if we have a candle like this, a Harami pattern like this, notice how deeply the market gapped down on the opening, right, and stayed down there. Right? That, to me, is more negative than would be if we had a Harami like that. And I think we could see why, right? Because the market didn't gap down. But in the Forex market, that's the way it's going to be. Okay? And a Harami, once again, is a small real body within an unusually long white real body. I'll use the bearish engulfing pattern as the dark cloud cover as a resistance area. I don't use Harami as resistance or support. That's one difference. Another difference is, to me, with the black real body wrapping around the white real body, the bearish engulfing pattern, the odds of a turn are higher than it would be with the dark cloud cover, right? The black real body only gets partially into the white real body. And the odds of a turn are least compared to those three with the Harami. Yes?
Would you say what you said prior to that last statement again?
Okay.
It was setting resistance levels.
A resistance, okay, I'll use a dark cloud cover and a bearish engulfing pattern as resistance. Remember, you take the high of the bearish engulfing pattern or the high of the dark cloud cover. The highest high of those two candlestick lines will make resistance. I don't use a Harami as resistance. Okay, so in other words, here we have that long upper shadow. On the left, I would not use that as an important resistance area. I still would use it as a resistance because it could be a pivot high, but it doesn't have the same consequence as resistance as a bearish engulfing pattern or a dark cloud cover. Now, let me ask you this. Where do you think I would be more nervous? What if I saw a Harami confirming a resistance area, an important resistance area, say horizontal resistance, and a bearish engulfing pattern that doesn't confirm resistance? Where would I be more likely to initiate a short sale? A Harami, yeah. Right, because it confirms a resistance area. If I saw a bearish engulfing pattern that didn't confirm resistance, if I was long and I had some profits, I would probably use it to exit a position or lighten up in a position. And this is really the main difference between using a candlestick signal to enter a new position as opposed to using a candlestick signal to exit. If a candlestick signal confirms a Western signal or another candlestick signal or some group of indicators, I would use that candlestick signal to initiate a new position. If a candlestick signal is not confirming something else, I would use that to exit a position or lighten up in a position. Not all candlestick signals are created equally. It all depends on where they appear through the prism of the overall market. So let's look at Harami here. Speaking of Harami at resistance, see how these two Harami emerged at a resistance area? And this is what the Harami will look like with the Forex markets. It's going to be a black real body that's right near the top of the prior real body. In fact, if the black real body got bigger in the Harami, and more than halfway into the white candle, what would it become? A dark cloud cover. Deeper, wraps around the white candle, bearish engulfing pattern. Right, so it's the degree to which the black candle gets into the white candle that we could make it more important. So a bearish engulfing pattern to me would be a little bit more important resistance than a dark cloud cover, and I don't even use the Harami as a resistance area. Why do you think the market stalled with the Harami? What pattern did we have on this chart before the first Harami? See, bearish engulfing pattern, black wrapping around the white. Even if you didn't have that, was it a resistance area anyway? Yes. Yeah. This is not a Harami. Why? White. And what else? Where's that real body in relation to the other real body? All right. It's above it. It has to be within it. Okay, here's another Harami confirming some engulfing patterns. Okay, here's a bull Harami. And even if the second real body is a doji instead of a small real body, it's still a Harami. Here's another Harami. We saw this before with the hammer. Remember somebody had asked the question about those small real bodies before the hammer? Okay, here we have a bearish Harami and a bullish Harami. I think those are two strong words. If you hear bearish Harami, you think the market's going to go from up to down. But just think of it really as the market, the bulls are losing their breath. And the bullish Harami, the bears are losing their breath. Now we've looked at single candlestick lines, the hammer, the shooting star, the high wave candle. We've looked at double candlestick lines, the Harami, the dark cloud cover, the piercing pattern. Now we're going to segue into the triple candlestick lines, where we have 3 candle lines, and one of these patterns is the morning star. Market's moving south, long black real body. Bears are in control or in command of the market. Then small real body, black or white. This is non-4X, black or white. The market is still, to me, is still negative because it's still it's holding the lows. But the small real body lessens the downtrend. I would have the short-term trend down a little bit more to neutral, but mainly down. The real turning signal comes in that white candle. Remember, we're looking at the psychology of the market. The bulls have now taken control of the market. We want to get deeply into the black real body, the first black real body. Okay. 4X. Okay, this is non-4X. You see how the real bodies don't have to be touching? In fact, this is ideal. If the real bodies don't touch, it's classic. With the 4X, you can't have that. Why? Because the opening and closing are going to be the same. So, with the 4X market's moving down. The close is here. The open will be here. So this is going to have to be a black real body or a doji. Okay. I said most of the time black or white because it can also be, even if we have a little bit of a white candle like this, that's fine. But most of the time it's going to be a black real body or a doji. The main thing, this would also be obviously a Harami, right? If this was a white candle. And then a white real body that gets deeply into the black candle. Now, notice how the black real body, where the black real body closes and the white real body opens, it's going to be the same. So what are beside a morning star, what are the last 2 candlestick lines forming? Bullish engulfing pattern, exactly. The main thing is, though, for morning star, in addition to also being a bullish engulfing pattern, it has to close above the middle of the black real body. This is what the morning star is going to look like in the 4X market. Okay. So here, there's a morning star. And why is there support there at that morning star? Where's that dotted red line come from? Previous support formed by what? A bullish engulfing pattern, yeah. Right. And you can see that that's a bullish engulfing pattern. That would not, if the black real body of that bullish engulfing pattern was small, okay, would that then be that 3 candlestick lines be a morning star? Did the white candle get deeply into the black candle enough? Okay. Okay. So I'm talking about over here. So let's imagine this is a small real body. Remember, you need a small real body to be a morning star. So let's imagine there's a small real body like this. Right. Then this white candle really has to get more deeply into the black candle to be a morning star. Yes?
The morning star, the lower shadows doesn't matter?
No. The question is, in the morning star, does the shadows matter? No. Nope. And you could use the I'm sorry, what's that? You could use the lowest shadow of those 3 candlestick lines as your support level. That's true with pretty much all the candlestick signals. If 3 candlestick signals make up the pattern, you use the highest or the lowest of those 3 candlestick signals. So the morning star is the 3 candlestick signal. You take the lowest low. The bullish engulfing pattern is a double candlestick signal. You take the lowest low of those 2 candlestick lines, the shadows, and that becomes your support level. Okay, here we have the evening star, non-4X. white candle, real body, black or white, that doesn't touch the white, ideally it doesn't touch the white real body, and then a black candle that gets deeply into the white candle. Now, many of the candlestick signals, I talked about be careful about some of the stuff you read about candlesticks. It's just not true. Like, I've seen ads, candlesticks, been around 300 or 400 years. That's not true. The candlesticks, as far as my research is concerned, really started when the equity market began trading in Japan in the 1870s. Before then, the Japanese really used the psychology of the market. And what they've done is, a lot of it is clouded in mystery. There's no definite answers. But from my research, what I've seen the Japanese have done to evolve the candles is they've taken their understanding of psychology and shifted into a candlestick pattern that reflects the psychological aspect of the market. So, for example, I had a book translated that was written in the mid-1700s, a Japanese book, and they talked about, in candlesticks actually, in Japanese, yang is a bull, they call it a yang candle and a yin candle. Yang is a bullish candle, yin is a bearish candle. And in the literature, this was pre-candles, this was in the 1700s, it says when yang reaches an extreme, there is stillness. This stillness gives rise to yin. That's the bearish engulfing pattern. White candle, when yang reaches an extreme, gives rise to stillness, the spinning top, and that stillness can give rise to yin. That's that black candle. So this is a non-4x, and here we have a 4x. Okay, because the opening and closing are the same, on that second candle line, it's almost always going to be white. Now, you may have an occasion where that second candle opens a pip or two above the close of the first white candle, so it may actually be a black real body, but almost always white and doji. So let's look at some examples to make it a little easier to see. So this is an evening star. Okay, here's another one. And see, this is a little unusual because that evening star, normally that second real body and that red semicircle, the second real body is usually white. Okay? But in this case, it opened a couple of pips above the prior close, so that's why you have a black real body. Yes?
Wouldn't that second red top be a spinning top?
Yes, the second one would also be a spinning top. What else is it also? The second part of that evening star. Remember the single candlestick lines we talked about? Shooting star, right? And why was there resistance there? Bearish engulfing pattern, right? Exactly.
Can you go back to that first one? Didn't go halfway into the...
Right, it did not, that black real body in the blue semicircle area, see that black candle, that's what that blue horizontal line is, to show halfway into the white candle. Ideally, we want to see it close, that black real body close halfway or lower into the white candle. And that's what the blue horizontal line is about. It shows us it didn't close.
That's really close.
Yeah, it's real. I mean, right. If you don't want to be, and you could also view it maybe as a bearish engulfing pattern, right?
Yeah.
So if you did sell on this, let's say you sold short, say it's confirming a resistance area, and you sold on this, as soon as the market closed above it, if you're short, you're wrong, right? Okay, here it did close under the middle of the white candle. But getting back to how, even if it didn't close under the middle of the white candle, wouldn't that be a bearish engulfing pattern? Right? The black candle wrapped around. Remember, with the 4x, even if a black candle wraps around doji, it's still a bearish engulfing pattern. So that would be a bearish engulfing pattern, and it would have more negative implication as the resistance area if it also closed below the middle of the white candle. Because sometimes the middle of the white candle becomes support. As I mentioned before, it's not a major support area, but it's support. Question?
Whether it's a harami or a bearish engulfing pattern.
The question is if it breaks above the resistance area set by any of these candlestick signals, evening star, dark cloud cover, bearish engulfing pattern, do you go right into it? And the answer to that is you have to show me the chart. You have to see what the support level potentially is, what your target is.
Do you attach any strength to this break chord? There may be support and resistance levels.
Right.
And then there may be a resistance level there, but if the strength of the move is such that it will break that.
Okay, he's saying if it breaks above the high of the evening star's resistance, and let's say there's another resistance area right above that, there's no way to know if the market's going to take that second resistance area out. Okay, I can tell you where support and resistance is. In fact, that's what we do with our daily commentary, both our retail daily commentary and our institutional daily commentary. We'll give 3 levels of support and resistance. And the reason for that is because there's no way of knowing if the market's going to break support or resistance. But if it does break, let's say, a resistance area, I could tell you the next resistance area, and that would mean keep an eye out for any potential reversal signals with candles. But you can't tell how much the market's going to move by knowing what kind of candlestick signal it broke through.
Can I ask differently?
Okay, go ahead.
How much importance you attach to breaking a reversal pattern?
How much importance do I place on breaking reversal pattern? It depends on how often that reversal pattern was tested. If it was tested a lot of times, let's say a hammer was tested a few times, and the market breaks that support area, I would place a lot more emphasis on that. We'll look at old support becoming resistance than I would be if the market broke under a hammer support one time. So if it's tested more often, a break is more important, yes.
But on this chart here, then you would have said your resistance is at the top of the bearish engulfing.
Exactly, right.
And you would have been taken out
No.
at that wide white candle.
Remember, when we talk about resistance, is the resistance based on an intraday move or a close? Close. So the market moved above the high of that upper shadow on that black candle, the bearish engulfing pattern, but didn't close above it. Right, didn't close above it.
But it might potentially take out your stop.
It might, yeah, intraday, you don't know if it's going to close above it or not. Right.
So with an intraday, you would have been stopped out.
Intraday, you would have been stopped out, yes. Right. And we'll look at setting risk-reward using intraday in a little bit. Okay, bearish engulfing pattern, which the evening star was also a bearish engulfing pattern, right? Remember the black candle wrapping around the white candles. Okay, and the market's at resistance here. Okay, would you sell short? Isn't the market at resistance? Okay. Okay, and why wouldn't you sell short? Right, the answer, and the correct answer is there's no signal hinting the bears are losing steam. And this is a vital concept we're going to be looking at specifically in a little bit. Okay, it's not just if the market's at support or resistance, but what candlestick signals we get at support or resistance. No reversal signals here at all. Okay, I don't know what happened after, but the correct answer is I would not be selling here. Okay, here we have an evening star, and the reason I wanted to show this is that long black real body, and by the way, the evening stars are 3 candlestick signals on the left. That long black real body confirms the evening star, but look by the time you got the signal. Right. Now, we don't know if it's good risk-reward because I don't have something on the left side of the slide, but the odds are it's probably not a good risk-reward if you sell on the close of the shooting star. So what you do is you set up in your software a resistance area defined by the shooting star, and you have it give you an alert anytime the market's near there. And back in February, it got near there, and it wasn't quite a dark cloud cover. See, back in February, early February, long white candle, that black real body did not get more than halfway into the white real body. But what happened the next session? It did, right. So that, to me, would be confirmation of the, or I call it a variation of dark cloud cover. What's that? That second real, good question, is this an evening star where the market confirmed it in February? I would not view it that way because that real body is a little too big. You want the second real body.
What did you call it, the bearish harami?
For a harami, normally, I think the definition we actually have is like 25% of the real body. Okay. So if you want a definition, that would be it.
Are you thinking more in terms of a blended candle on those 2 black
Yeah,
candles?
yeah. The question is, we're thinking of a blended candle. That's something we're not getting into today, but there are ways to combine 2 or more candlestick signals to make it into a single candlestick signal, and then you read that individual candlestick line. Okay. Now, the Japanese have a wonderful expression. It says, a workman must sharpen his tools if he's to do his work well. And now we're going to look at tools that we could be using to really focus on harnessing the power of the candlesticks. Okay? Don't ever forget risk-reward. We touched on that before. I know it was a little ahead of what we were me bringing it up now, but it's just so important. And these are the topics we're going to be talking about in detail in the next session here. The if-then system. Okay, stops, always use them. Candles in context. Intraday candlestick charts. Okay, pace trades according to the market environment. Let go of emotions, psychology. Right? I laugh there, right? That's if only I could be like Data or who's the Vulcan Spock. If only I could trade like Spock, right? That's a great title for a book. Trade like Spock. Indicators, the more the better. Okay. Never trade without an eye to news. A technical analyst is talking about news. You'll see why. Yeah. And examine how the market acts at support and resistance. Essentially, these tools will allow you to have discipline. And if you think it was easy coming up with that anagram. And what we're going to look at now is the disciplined approach. It's really a blueprint for what I call trading success. So we're going to go through the anagram discipline, the D, the I, the S. They won't be in order, though. Okay, so as you look at them, don't think they're going to be in spelling order. And the first one happens to be a D. We're going to do a D. Don't ever forget the risk-reward of a trade. Okay. One of the questions I was asked during the survey, on the Forex survey, is when should you ignore a candlestick signal? I mentioned this before. When it's a bad risk-reward. I don't think ignore is the right word. When should you not trade on the candlestick signal? Ignore it means you completely forget about it, but you saw with many of these candlestick signals, right? If you had like that evening star and it's a bad risk reward, don't ignore it. Just don't use it for the trade at that time. Make it as a resistance area. Okay. It's probably one of the most important things that you're going to do to improve your trading profitability by always looking at the risk reward. Okay, how many of you have done that when you looked at a candlestick signal, thinking about looking at what your stop level is and what your profit potential is? How many? See? How many will now? You all had better raise your hand, because that is really going to separate you from the competition, really and truly. And I think just knowing that will pay for this workshop many, many times over. If it's a bad risk reward, you don't do the trade. Okay? And I found this optical illusion here. This is pretty neat. Let's see if this works. Now you see them all moving around. Does that work on here? Yeah. See it all shifting around, all like psychedelic. But they're really not. Okay, I'm going to put this line here. Just focus on one of them. Just one of these little peanuts or whatever they are. You can see it doesn't move. It stops moving. Okay. The idea of this is know what to focus on. Always, always focus on the risk reward. Okay. And that's one of my trading principles. It's number 4 here, but probably as far as importance is concerned, it should be number 1. You always have to judge the risk reward of a potential trade. Okay, here we have a hammer confirming support. Now, I could tell you that this hammer is great. Look how nicely it worked out. Look how the market rallied after. But in the real world, when we're going to be trading, when you see that hammer, what about the risk reward? Is that a hammer that one should be buying on? No. Because the risk reward, that red line there is the area you think about buying because you need a close. That would be my resistance area. Once again, yours could be different, but this is what I'd be looking at as resistance. So your risk is in the blue vertical line. I'm sorry, your target is the blue vertical line, and your risk is the red hammer. The red arrow, I'm sorry, the red arrow. Does that look like a good risk reward? It looks like you're risking 1 to 1. It looks like almost maybe, 1 to 1. Yeah. Okay. Same thing. Question? I probably wouldn't. The question is, where would I enter? Unfortunately, the market didn't pull back to the hammer. Where might I enter, though? Where I don't know if we're going to look at this one, but it's actually one where we got in the middle of the lower shadow of that hammer. By looking at an intraday chart, we got a buy signal. You didn't have to wait for the close of the hammer. We'll look at that when we talk about intraday. But what you could do is, we know it's a hammer. We have to wait for what? The close, right? It's not a candlestick signal until it's a close. What happens during the day if the market's pulling back and then starts moving up is you may say to yourself, what candlestick signal is that hammer confirming? It's the white. It doesn't quite wrap around the black. What is that? Piercing pattern. So we know we have a potential support area based on the piercing pattern. And although we don't know it's a hammer until the end of the day, if the market gets near that low of the piercing pattern intraday and then starts pulling up, you may be buying it then, okay, because it's confirming a support area. But if you're just looking only, if say you work during the day and you come back at the end of the day and you have the hammer, you wouldn't have done any trade because it didn't pull back to the hammer for us to buy it again. You missed. That's right. Yeah. Right. Yes, you can buy it with the resistance areas broken, and what I would do is classic Western technicals, when we're in a lateral trading range, a box range, the Japanese call it, is you take whichever way the market breaks out, you take the height of the range. So here it broke out to the upside, and this is 172.40, hard to see. Yeah, 176, so what, about 350 pips, am I doing that right? So at 350 to 176, my target would be 179.50. Keep in mind, a target doesn't mean that is necessarily where it's going to stop. It's a minimum target. It could get above that. And also, if you're trading with price patterns, and we'll look at price patterns in a couple of minutes for targets, it doesn't mean you let the whole position ride until you get to your target. Nothing wrong with taking profits along the way. Okay, here we have a bullish engulfing pattern, also a hammer. And risk reward, I don't know, it might be 2 to 1. I have to look at the numbers, but it doesn't matter about the numbers here. The idea is I want you to get very used to always thinking about this concept, about if you're placing a trade, where's the stop and where's the potential target. Okay, here we have a morning star, light green. By the way, the arrows here, this is actually, we're in a beta test now of the scanning software, and on the top there, the arrow says morning star. So what I did was I said, okay, find the morning stars in the, I don't know what this is, this might be euro, in the dollar yen. And it highlights it. So you have the green rectangle, maybe a little hard to see there, but it just picks out the morning star based on my definition. So the trend was down. Okay, it looks lateral, but the trend was actually down based on how I define trend, and that is proprietary for the software. Now, just because it's a morning star, that's only part of the challenge. Now you have the candlestick signal. What do you do with it? Do you buy with it? The answer in this case is no, because of the poor risk reward. So just because if you use a scanning software or you do it on your own, you have a candlestick signal, use that as your first step. The second step is analyze if the risk reward is attractive. In this case, it wouldn't have been. Yes? Yes. Yeah. He's saying, just to be clear, isn't that followed by an evening star? And the answer is yes. Exactly. Now, if you view that as an evening star, which I would, why would you not sell short on that evening star? It's still at a support level, right? I'd wait for it to close under the evening star, and as soon as it closed, actually, it closed under the morning star. As soon as it closed under the morning star, that to me was quite negative, because not only did it close into the morning star? Wasn't that morning star confirming a support level? Right? So I would be perfectly comfortable being short there. That's a momentum play, right? We have the morning star. At least that keeps us in from going in from the short side. Where do we go short if we see a morning star? Let it break the support area of the morning star. Okay, let's think about this risk reward. Okay, what do you think? How many like it?
Excellent.
Yeah, I think it looks great. Yep. I think it looks really good. The hammer support and resistance, I would say, once again, a little hard to see. This is the dollar Canadian, around 125. One of the things we'll look at later is prior support can become resistance. So we may have had a support area over here. So that would be my first potential resistance. I would call this R1. But the much more important resistance would be up here at R2, at that second red line. But even if you view R1 as a conservative, what I'll do sometimes is have a conservative and a more liberal target. Even if you viewed R1 as a conservative target, I think this risk reward looks fine. And if your question, then go ahead.
You won't enter at that hammer, right? Because all the next candles, some of them goes below hammer.
Okay, none of the candle signals after the hammer closed under the hammer. They moved under the hammer, but they didn't close under it. I don't think so.
High wave,
I don't think any
to the right.
Oh, yeah, I see.
Below the
it didn't close under the hammer. It moved under it, but it didn't close under the hammer. And in fact, if you were a little nervous about buying the hammer, which is perfectly fine because although it's a hammer, is it a new low close for the move on that hammer? Isn't that a new low close for that move? Right? So we'd say to ourselves, okay, maybe we'll buy on the hammer, but nothing says we have to be fully in the position. 25, 50%. And then as the market is building a base there, we could add to the position. I like it when the market expands on the base. Okay, the Japanese say ice 3 feet deep doesn't form in one day. And something like this is absolutely great because you're expanding on the base. And when that happens, once the market goes, it could really get going. And what's nice also about expanding on the base, you have a very important support area. So for momentum players, if we're expanding on the base here and the market closes under the hammer's low, that's the time to go short. For those who are playing the candles as reversals, as long as the hammer holds the support and expanding on the base there, I would be adding to long positions. Okay, the if-then system. We're spelling out discipline. Again, it may not be in order. The first two we happen to be DI, but we're doing that, but they're not all going to be in order. If-then. That means if the market does such and such, then we react accordingly, if-then. So if the market breaks support, then we think about selling short, like the prior slide, right? If the market breaks resistance, then we could think about going long. If the market stalls at resistance, then we could think about selling short. One of the major mistakes many traders do is anticipate. So let's say we have a very important support area, and the market is holding support, but there's no bullish candlestick signals yet. Some people may say, hey, I'm going to be buying on the support, thinking it's going to hold, but we really have no confirmation. And very often in that case, if there's no turning signals with the candles, the markets will break support. Once again, it becomes a trade-off between profit potential and risk. Let's say the market, let's do it the other side. Let's say the market's moving up and it's getting to a resistance area, and you're thinking it's going to break through the resistance area. You don't know until it's done that it's going to break through resistance. The market's at resistance, no signs yet of either, let's say the bearish candlestick signals. The market's let me backstep here. Let's say the market's at getting to a resistance area, It's moving up. Now, do we know if it's going to break support or, in this case, resistance? Do we know the market's going to break resistance? No. Let's say you feel it's going to break resistance. So you're going long before it breaks the resistance area. If you're right, you have more profit potential, correct? But what about the odds of the trade working? Less. Of course, the market has not yet broken the resistance. If we wait for the market to break resistance, the odds of the trade working are much higher. We do have less profit potential. I prefer the latter scenario. I'd rather have the market break resistance to let the market tell me the bulls are really in control. So the way I would look at it, if the market breaks resistance, then we can go long. Okay. If it breaks support, we can think about selling. This is really what momentum trading is all about. Okay, here we have a hammer and a bullish engulfing pattern. How about from a risk-reward perspective? What do you think? Looks great. Looks excellent. Looks fine. Okay. If you do a trade and it doesn't work out within a certain amount of time, then get out. It's called a time. We're going to look a little bit at stops later on. I talk a lot more about stops in my advanced DVD, but we'll talk a little about it today. It's called a time stop. You don't want to commit capital to a trade that's not working out. So here we have the bullish engulfing pattern, and it's just meandering. This is an intraday chart, but I don't know if it's days or whatever this period is. But this is a trade I would not want to stay in. The general idea with the if-then also, if you do a trade and it doesn't work out, then get out. Whether that means a time stop if it doesn't work out within a certain amount of time, or if you're buying, let's say you're buying on the bullish engulfing pattern, and then you're looking for a particular target, and it gets maybe within a few ticks of it and then starts pulling back. Keep in mind, a support and resistance area are not exact. A lot of people forget about that. So even if you get to within a few ticks of support or resistance, you could think about getting out of the position. But the general precept, if-then, if the market does something, then we react according to what the market is telling us. What's that?
Doesn't this look like a continuation pattern?
Okay, the question is, doesn't this look like a continuation pattern? So after the bullish engulfing pattern, the market moves sideways. And once it breaks that sideways moving action, we've broken out of a horizontal trading band. Okay, then we can think about going short. Very often when the market's in a consolidation band, and this is another reason you should be out of the position with that bullish engulfing pattern if the market isn't moving, it doesn't move up soon, because if you have a downtrend and the market starts moving sideways, theoretically, they've done studies, this is years ago, I don't know if they've updated them, and this is in the equity side, I don't know about, I don't think they ever did this in the Forex side, but the odds favor a breakout in the direction that the market had before the lateral band. So in other words, what was the direction between before the box range? After that bullish engulfing pattern, what was the, when the market moved in the box range, what was the prior direction? Down. The odds slightly favor a downside breakout, yes. So that's
Can I say that the risk rewards, the resistance area is only for entry level. Once you're in the ticker position, you can really ignore that the risk reward area, resistance or support area. Once you are in a position, and then you should look for a time frame, how long you want to stay in a position. Right.
The question, he's bringing a great point, that when you have the position, you're looking at the risk reward when you first put on the position, but we should be thinking about a time frame also. How long are we going to give to get to that target? Right, exactly.
They repeat themselves over and over. So you can do back testing. Is that true with the Forex? Can you look at the pairs and say they react this way?
The question is, can you test the candles, essentially, in the Forex market? And the only way I would suggest doing that is using them in addition to what you normally do. I would never say buy on every bullish engulfing pattern. Okay? Why? You have to define the risk reward. You also should look if the bullish engulfing pattern or the hammer is confirming another support area. So this is, again, the biggest misuse of candles. And those who try to backtest it don't do it right. I've seen articles in Stocks and Commodities magazine. The candles work really bad. They work really well. It depends on the testing. It doesn't matter. They're not testing them right. Trading with candles in isolation is, like the Japanese say, like leaning a ladder against the clouds. Okay, there's nothing substantial. You can't just use the candles. You have to think about risk, reward, money management. The trading, the triad we'll look at later. Candles, Western signals, and money management. Candles is just one leg. Yes? Mm-hmm. Oh, yeah. Oh, yeah, the hammer and the bullish engulfing pattern is a great risk reward. I would be doing this trade. The point is that when it was by trading sideways for such a long time, I wouldn't be committing capital. I wouldn't keep the capital in there.
So at that point, since you have the bullish engulfing and you have the hammer, why wouldn't you make the entry right there?
I would. I would. Right. There's also something called a time stop. If the market just meanders, you're holding your capital is being committed there. There's other markets you could probably much better risk. I should say better risk rewards, much better trading opportunities. You don't want to tie your money up on a market that's doing nothing here.
Much downtrend.
Mm-hmm.
Do you think just that pattern, candle pattern, confirms a shift in psychology?
Okay, because the market is in such a big downtrend, does these candle signals show a shift in psychology? For one thing I would do is, getting back to her question about a daily chart, I would see if this hammer or an engulfing pattern is confirming a support area in the daily chart. Okay, we'll look at later, for those who trade intraday, take a daily chart support or resistance and throw it onto an intraday chart. And then if you get a candlestick signal confirming that daily support or resistance, to think about pulling the trigger. But my feeling is, because you had both a hammer and a bullish engulfing pattern, one confirming the other, then I would go long. If it was just a hammer, probably not. And we're actually looking now at money management strategies, the basics of money management. And when we look at the risk-reward, obviously one aspect of the risk-reward is, if we're defining the risk, we're defining our stops. So we always need to use stops. A question I was asked is, with the Forex survey, is how do you deal with false signals? Stops, right? You don't know it's false until the market tells you it's false. Okay. There's always a price that says we're wrong. That's what stops are all about. The Japanese say it's better to bend than to break. And probably the way that people get blown out of the market is, the most common way is taking those huge one or two tremendous losses. And don't think that the market, well, on the equity side, the market makers, on the Forex side, maybe the banks, they're not going to be gunning for your stops. Don't worry about it. Unless you put them in an obvious area. I mean, if you put them at the zeros, you have like a support area at 122 in the yen. Okay. Everybody in the world might have a stop there, so they're going to be gunning for the stops, So what you should do is put it maybe 10, 20 pips under there, because that's as far, you don't know how far the stops are going to be taken out, but they gun for the stops all the time. So if it's a very obvious chart point, by obvious I mean a round number, think about that. They're not going to be gunning for your stops, they're just gunning for everybody's stops, because they know retail uses the round numbers. Yes?
Do you think that's part of the reason for the crack and snap?
Yes, definitely. Well, the question is this part of the reason for the crack and snap and falling off the roof, which techniques we'll talk about later. Yes, definitely. We'll look at that in a bit. And as smart as we are, remember one thing that's always, always true, that the market is never wrong, okay? Oh, yeah. Face it, yeah. Okay, here we have a bearish engulfing pattern with the with the red semicircle in late January. The market closed above it, so remember with the idea of stops. Okay, so the market closed above it. And if we're short, we would have been stopped out. Okay, question. What is that second red semicircle? What kind of pattern is that? Bearish engulfing pattern. So the question is, and the bearish engulfing pattern, the high of the bearish engulfing pattern was around 119.25 on the dollar yen. Okay, so where's your stop? Okay, 119.25, right? Right. It's not 119.25. Okay, it's 119.50. Why? It's so close. I mean, wouldn't it be very upsetting? I mean, the market did stall there. It did happen to stall. That red line happened to be the high of the bearish engulfing pattern. But what if the market got above 119.25 and got to 119.40? Would you want to be out of your short position? No. So this is why we'll have zones. Very often we'll have zones of support and resistance on our service. S1, this would be like, I don't know if this would be R1. This would be like R1 would be a zone if the market had ended today. Our R1, our first resistance area, would be 119.25 to 119.50. And what we do in our newsletter, it's called Illuminations, is we give reasons for support or resistance. So it's a great educational vehicle also. So for example, for our first resistance, we'll have 119.25 to 119.50. We'll say high of bearish engulfing pattern to recent pivot high. Okay, here's a technique I discussed before about setting stops without waiting for the close. Now, we have the shooting star confirming a resistance area. We know that we should wait for the close above the shooting star to say that the market's broken above resistance. But if you waited for the close in that session, look at what happened. Let me show you a little trick to use so you could use an intraday stop. First of all, we define what our price target is. So the shooting star closed at 121.92. Our target, my target, I shouldn't say our target, because yours might be different than mine, is down here around 121.60. So it looks like we're trying to make 28 pips, our potential reward. So our potential reward is 28 pips. Now, let's say we want a 1 to 2 risk reward. So now we're going to go backwards. We're saying we're looking to make 28. What does that mean? We're willing to risk. Now we're ignoring the bid offer spread. So let's forget. So we're going to go 14. So that means that with the close of the shooting star at 121.92, that's where we initially shorted. So for a 2 to 1 risk reward, it's actually the other way around. Reward risk. It should be 1 to 2, but everybody says risk reward. We're risking 14 basis. So we're risking 14 basis point. So what we're doing is we shorted at 121.92. We add 14 basis point, and this becomes our intraday stop. Anybody want me to go over that again? You see what we've done? We took the profit potential of 28 pips, and we worked backwards, and then we defined what our risk is. Isn't it pretty cool? Yeah. You won't see this anywhere else. This is not in my books. I don't know if I've never seen this before. Anyway, yeah. Yeah.
So would you put in a stop order for just that one day?
Yeah. Yep. The question is, would you put a stop in order for this one day? What do you mean? I'm sorry. The question is, would you put the stop order? Oh, no, intraday. No, the question is, would you put the stop order in for this one day? You'd put the stop order in intraday. It would just be there, stay there. Okay? Right. Right. For those, the ideal stop, I mentioned before that one should place their stop before the trade is initiated. We'll look a little bit more about trading psychology in a couple of minutes, because when we most objective about the market, before we're in the trade, right? The best traders, and unfortunately most of us are not going to be able to do this, don't put in stops. They have mental stops, because they want to be able to pull the trigger on the trade. This is especially for intraday traders. They want to be able to pull the trigger and watch the market. But to be able to do that is a wonderful psychological asset. To be unemotional, say, okay, I'm wrong, get out. Most of us are not going to be able to do it. We're going to second guess ourselves. So for just a blanket statement, always place your stop in before you do the trade. Yes?
Whenever I trade on an intraday basis, sometimes I have experienced a spike by the auto desk. Sometimes I got wiped out, no matter how many, I have leverage on the stop level. So usually intraday, I don't set up the stop,
Okay.
but I set up the limits.
Okay. The limit, the entry limit, the buy and sell entry limit?
Yes.
Okay.
So and then once I enter,
And I'll repeat the question. Go ahead.
okay, once I entered in a position and I determined how much I'm going to have a limit, but I didn't put down the stop.
Stop. Okay. And you watch how the market reacts?
Well, and then most of the time I lose.
Okay, most of the time. All right. What he was saying, what Young was saying, is he'll put a trade on, but then he won't have a stop in there. He'll be watching the market, but most of the time he loses. Okay, nothing wrong with putting a trade on and then saying, okay, I'm going to watch it and see how the market acts to see if I'm going to be out of the trade or not. The advantage of that, again, as market circumstances change, we can adjust our stop. The downside with that is if you don't have a stop beforehand, how do you get your risk reward? You can't, right? You can't get your risk reward. Even if it's a preliminary stop, I think you should do that because this way at least you're defining your risk. You can change the stop later on, and we'll look at some slides later about adjusting stops. Yes?
I don't think you can have a stop in before you do a trade, but the trade's got to be existing before you put a stop in.
Right.
Otherwise, it's a new position.
Okay, he's saying the trade has to be existing before you put the stop in. But what you do is you set up the reasons for the trade. Bullish and shooting star. Okay? I'm going to sell in the shooting star. The shooting star came before you pull the trigger on selling short on that shooting star. You say, I'm selling the shooting star. My target is here and my risk is here. So you've defined your risk and reward before you put the trade on. And then you put the trade on, and whatever happens, happens. If you get stopped out, you're out.
First, you have to do the trade.
Right, but before you do the trade, you have to define what your stop and your risk is. Right.
But actually, what Anthony said is that it is possible to set up the stop before you have any position, because you place an order at the stop level,
right,
and then you enter the trade.
You have to enter the trade first, right? You have to enter the trade first, right? But you should know in your mind what the stop is going to be. Yes, right, right. Yes. I'm sorry, what were you saying?
Don't you calculate the opposite way rather than looking at the target first and see what my stop is? Suppose you have a stronger resistance area,
right,
higher level charts, and you see it's close. Like, let's say this.
Oh yeah, right.
Let's say it is 20 pips away from where we calculated here. So me going to 14 pips stop means I'm asking for trouble.
What he's saying is if there's another chart, maybe a higher level chart that has resistance instead of, what did I say, 14 pips higher, 10 pips higher, definitely. You should always look at where support and resistance areas are. And even if you trade intraday, you always have to look at a daily chart. We'll look at an example of this later on. Because if you don't, you're really asking for trouble. And we'll look at this when we get to intraday. Okay. Indicators, the more the better. And this is that grouping of indicators, or confluence of indicators. It could be a group of candlestick signals, one confirming the other, or it could be a candlestick signal confirming a Western signal. And this is one of my trading principles. Okay, the more signals we have joining together, the more likely a reversal. So here we have a hammer and a piercing pattern. But while this is what I call a confluence of candles, a grouping of candles, this would not be a good risk reward. We'd have to wait for a breakout above the resistance area. And I think we saw the slide before. See the hammer? By the time you got the signal. Okay. Here we have a bullish engulfing pattern confirming a hammer.